Hello, it's Big Cheds, and this is part of the Trading Encyclopedia daily education series on my YouTube channel, Cheds Trading. You can find me on Twitter at Big Cheds and Bitcoin Live, where I am a founding analyst. For today's lesson, we're going to talk about the idea of a price level and how important is that price level? How do we know how important is that price level? Well, we're going to talk about classical charting. And in classical charting, there's a few rules of thumb that I want to talk about. So a price level is formed by multiple price interactions with that level. Now, ideally, you have what's called time interval in between these attempts. Here, it's a certain number, doesn't have to be an exact certain number of days, but very clearly a time interval, some time has passed, rather than testing it here and then immediately testing it again. You think of this as one test of the level. So you want to have multiple time points with time interval in between the attempts. And then you also want to have something like called price distance to the lows. So something like it comes down, it does something, it comes up, it does this again, it comes up. You have price distance between the peak and the trough, and the peak and the trough in between these attempts. So basically what that means is it attempted to break the price level. There was a consolidation. Something happened. The supply and demand was rebalanced, and the price again attempted to break the level. It did it again. So, and then again, the price interacted with the level. It makes it more meaningful. So that's how a level is formed. And what we want to remember is the more times the price interacts with the level, the more important that level is. And the more significant a break of that level will be. Also, the more times the price tests a level, the more likely it is to break. So those are the two most important rules of thumb. The more times the price interacts with the level, the more important it is. And the more times it tests the level, the more likely it is to break. We'll take just a quick example of one of these levels on Ethereum. Here on the weekly chart, you have a very well-formed price level at 2150, where support became resistance. We did a consolidation and tried to break out again. We did a consolidation and tried to break out again, and it did. Had multiple now attempts from above before a brief deviation and being back up above that level. The price is still respecting the level. Here's the third thing to remember. Even though this level is incredibly well formed now, if the price starts to now chop through this level, it's not going to be as important as it used to be. So that, I will say, is actually the third rule of thumb. First, the more times it interacts, the more important it is. Secondly, the more times it tests it, the more likely it is to break it. And thirdly, if the price is now disrespecting the level, then we will as well. We're no longer paying attention to it. All right. And these are essentially the rules of thumb for how important a level is in classical charting. And this is part of the Trading Encyclopedia daily education series on my YouTube channel, Cheds Trading. Find me on Twitter at Big Cheds and Bitcoin Live, where I'm a founding analyst. Folks, thank you. Thanks for being here. Hope you're having fun, and I'll talk to you soon. Big Cheds out.